How are you doing, Liz? We appreciate you joining us.
Hi there. Yeah, thank you for having me. I'm happy to be here.
I would love to kind of hear your thoughts on how this market has been going. Obviously, big tech has been leading the way, and that leadership has been pretty narrow.
Yeah, well, I mean, you rightfully point out that the leadership is incredibly narrow. Generally, my thoughts on that are that it's a fragile rally. We're in a place right now where the narrow leadership, I think, is maybe making investors nervous and is probably presenting the risk of some inflated valuations in particular names, but inflated valuations and maybe enthusiasm that's gotten pretty far ahead of itself just in the short term. But that being said, I want to acknowledge the fact that there are obviously buyers in this market. And I think it's been astounding to a lot of people. And professional investors, maybe especially the environment otherwise, the macro environment and the monetary tightening environment and the inflation environment, and you name it, right? There's a lot of signals out there that are telling us to be cautious. There's just been still some relentless buying appetite, particularly in those tech names. So I think this market is kind of stuck between a lot of people who want it to be the new bull market and other people who are saying it just can't possibly be that way. And we're sort of having a tug of war until we decidedly move one direction or the other.
Are you looking into the second half of the year for the labor picture to shift? What are your thoughts on employment in general so far this year and headed into the second half of the year?
So the labor market has been one of the pieces that I think continues to perplex macro strategists. The JOLTS data today surprised to the upside, meaning there were more job openings than we expected there to be or what estimates had expected there to be, which further reinforces the idea that the labor market is just incredibly tight, right? More jobs open than there are people to fill them, and we carry forward in this same fashion. There are a couple things, as with any data point, under the surface that are always important to note, and you always want to note the market reaction to that data as soon as it's printed. So what happened today was the JOLTS data got printed, surprised to the upside with more openings, and yields spiked a little bit, but it was like a very, very tiny spike. And then they sort of came back down. And our speculation on why that happened and why the spike was limited is because you saw a pretty low quits rate. So embedded in that JOLTS data is a measurement of how often or how willing employees are to voluntarily quit their job. And if you just think about that from a common sense perspective, somebody's not going to quit their job unless they feel pretty confident that they either can find another one. So the quits rate was quite low. And if you watch the relationship between the quits rate and wage inflation is pretty tight usually. So if the quits rate comes down, you typically see wage inflation follow suit. So there were some things under the surface of today's report. You know, there's always the headline and then there's the rest of it. The labor market has gotten, I would say, incrementally weaker. So small and mid-sized businesses make up, I believe, somewhere between 70 and 80% of the overall labor force. And what's happening right now, again, under the surface to small and mid-sized businesses is credit has tightened. So credit has tightened in the sense that it's been more difficult for small businesses to get loans or to get financing. And if they can't get that financing, they can't finance their operations. They may have to engage in layoffs and so on and so forth to save costs. So there's not as much money available to small and mid-sized businesses. And that's sort of something that's being talked about under the surface, but hasn't hit the mainstream quite yet. And I suspect that over time, that shortage of credit to those businesses will impact the actual labor numbers.
Feels like the debt ceiling is coming to a head here. I kind of want to ask your thoughts on that. It kind of felt like the market never really took it seriously. The market really was never moving off of those headlines.
I don't think that the equity market took it very seriously, or at least in the sense of I don't think the equity market priced in a realistic possibility of a default and what that would look like if it had to ripple across, which I think ended up being the risk coming into this. And to be fair, it hasn't been entirely resolved, right? It still has to pass Congress, but all signs are looking like it's going to work out. But I don't think the equity markets priced in the real possibility of a default and of Congress not actually coming to an agreement. So there was obviously some consternation by some investors. I don't know that anybody realistically thought that the U.S. would default and, kind of fall off into some sort of abyss from a treasury perspective. But the chance of there being volatility and just something else that we would have to layer on top of this market where we're all still sort of looking around the corner for, are we okay? I think that was the part that was the risky scenario. So there's definitely a possibility that if and when we get final closure on it and we know that it's passed and we've sort of averted disaster for the time being, that you get a pop in the stock market. I think because it wasn't entirely priced in that things would go poorly, that maybe limits the upside in a pop, because I think the market had sort of assumed that we were going to figure it out one way or another. So there may not be a ton of upside in that particular circumstance, but you may see a little bit of a pop in general.
The hype of this year has been AI. It has been going crazy. I would love to get your thoughts on the AI theme, both kind of short term and then also long term.
Yeah, so the AI, nothing short of amazing of what's happened to a lot of the stocks that are tied to it and the move that's occurred. Some of the things that I think investors should keep in mind. First of all, I think AI definitely has the possibility to be transformational across a lot of industries. And something that happens over a number of years, it may even end up creating jobs. It probably will hurt some other jobs, but if it happens slowly and with time, it could end up creating jobs as well. So there's sort of this mixed bag of the economic impact it could have. The thing I would think about as an investor is that the enthusiasm around it has been something that's happened in relatively short order in the stock market. So be careful thinking about, if this is what I'm going to pay for this stock today, do I think I'm going to get gratification on this valuation in the next 12 months? And I think the AI movement and the uptick of it is going to take a 5 to 10 years, right? So you may not get gratification on that particular valuation and what you would pay for it after a big run up like this. And anytime you have a new technology or something that is transformational, there's a life cycle to it. And that life cycle, especially on the early side, is going to include somewhat of a boom and bust cycle. And there's going to be companies that do it really well, and there's going to be companies that don't end up keeping up or don't do it really well. So it's a difficult theme to buy broadly right now. And I think the enthusiasm is warranted, but I would be careful not to be too short-term oriented on when you're going to get the satisfaction of saying, okay, it was worth it to buy that stock at that valuation, because I think it might take a little longer.
If you want more great ideas and education around finance, go ahead and hit the subscribe and like buttons.